Okay, folks, so we have to discuss two things. Number one, we need to discuss the setup of Adder heading into this lovely week. It went parabolic the last couple of weeks, but can the momentum continue? We will discuss potential catalysts and pain points that you're going to want to know about this week. And then lastly, for the main entree, I want to discuss something that I believe may explode. Why, what, and how do you play it? Okay, let's go ahead and start with a lovely little Addergator. So this is a setup that we've been covering in depth since the pre-market of April 4th, and it's been one of the most consistent squeeze setups of 2022 thus far. It hit nearly all of our bull criteria the last couple of weeks and even fought off market-wide cooldowns. On Wednesday, you hit a new high, which was led by a combination of market makers hedging their sold and newly in-the-money call options. Some got exercised and then dumped onto the market towards close that day, which caused a wider sell-off. Now, on Wednesday's video, we talked about how you'd likely see a similar situation on that last day of the trading week on Thursday, where if momentum held, you'd have market makers trying to further hedge, but you'd also have the rest of the options being exercised throughout that day. And my prediction was you'd see a breathing day in totality. You did get that original pop just like we saw on Wednesday, and then you did get a breath. But the breath wasn't much. 2% down on a stock that's up this much in the last 2 weeks? That's crazy. 2% down translated into hype terms is like 0% down. These stocks could easily drop 20, 30, 40% when you have this kind of setup and you have a breathing day. But Addergator showed some serious retaining power. You look at popularity, Adder as of right now still retains the #1 spot on Reddit as registered by Ape Wisdom. On StockTwits though, it has fallen to number 3 right behind Nile and Mullen. Still pretty high up there, but you're not seeing the same momentum over there. They have been traditionally a little bit less popular of a ticker at that platform. You go over to the Ortex data, you now have 70.58% of the free float on loan. If you recall last week and you look at the data that actually shows it right here, it was at 63.21%. When you have cost of borrow fees going through the roof and utilization at 100%, all of a sudden there's a rush to lend out more and more shares. But of course, somebody who owns a share has to be in a broker or in a position where they allow relending of their shares in order for this number to go up and for more shares to be available to be loaned. The closer you are to 100%, the harder it is to find more shares to loan. I didn't think you'd see it climb to 70%, but here we are, and the price still hasn't come down much. You look at the cost and risk profile and how aggressive short sellers are being right now, it's pretty obvious that a lot of resources are being used to get this down as fast as possible. You look at other heavily shorted stocks like AMC or GME, AMC is sitting at 26.49%, GME 33.86% of shares of that free float lent out. Adder's at 70.58%. I mean, they are literally trying to do everything they can to throw the book or prepare to throw more books at Adder. Obviously, the big story with AMC and GME is also the potentially strong naked shorting that we have seen symptoms of for quite a while, which means shares that were sold onto the market that weren't ever really borrowed in the first place. That's also a story with Adder, and dare I say, it may be even more extreme. And the CEO himself acknowledged this last fall, which you haven't really seen that many publicly traded company CEOs actually acknowledge the presence of, well, naked short selling. If you look at the history of Adder's failures to deliver, it's substantial. The biggest period was the August-September rally that also, of course, corresponded with 100% utilization. As time goes on and failures to deliver are reported, I'd expect we'd see a similar trend, if not more extreme trend, the last few weeks as well. But there's certainly some symptoms that you can look at that indicate that there's a lot of selling pressure that's available despite the limited quantity of shares that are available. The problem, though, is that, of course, we have blinders on and we don't have 100% of the data here. So it's very difficult to understand exactly what's going on behind the scenes. But based on what we do know and the data that we do have, it's pretty obvious to me that short sellers are throwing the book at this, which means extreme profit for them if they can get this down, but potentially extreme and quick losses for them if they can't. But the way that I look at this heading into this new week is the longer this goes on without making a new high, the more likely it is to die off and break through previously conquered support levels, which is not what you want to see. Once you go so far as breaching the trust in this momentum cycle, it can oftentimes simply become a huge race to the bottom where people panic sell out, and a lot of people that got in at much lower values and are up huge end up saying, you know what, I'm going to go ahead and lock in my profits. That's the point where you start getting everybody running for the hills, and that causes a lot of panic. And that's the point where you get some of the biggest pouncing from people who are short this. If you think people are confident shorting this as it goes up, wait until it starts going down. All of a sudden, people are like, yeah, now it's time to start really throwing the book. You do not want a cascading crisis of confidence, and that's why you really do need to see this at least attempt a new uptrend this week, as well as retain those levels. Now you have some wiggle room in terms of attempting a new uptrend. I do believe, especially after Thursday's 2% down day, that it probably could take a day or two more of breathing. before another bounce back. But a few days of big breathing combined with a failure to retain crucial levels is going to cause a lot of folks to lose confidence, and they're going to look at this as just another momentum play that came, went, and died. It is what it is. If you look at 100 of these plays, 99 of them went down before shorts really got squeezed. On the bright side though, right now we are heading into a week with a lot of strength. We just came off a new breakout, it almost managed to make another new high, and its retention of the overall uptrend is strong. And if you do go over to the options chain, it's very, very possible that we see a repeat of last week if we hold above crucial levels. You look at the most concentrated call options that expire on April 22nd at the end of this coming week. Right now, it's the 350 and the 4, but also the $4.50, the 5, and the 550. Market makers probably hedged decently for the 350s and below on Thursday and days prior. But the biggest concentration of bets is on ATR expiring at just over $4 a share. And keep in mind, though, that we are entering this week at over that price, a decent amount over that, at $5.53, give or take the after hours. If we simply retain the levels that we're at right now, well, as time passes, guess what? We get closer to that expiration and closer to these previously unlikely call options expiring in the money. And if that happens, you're going to have what happened last week, which is another rush of call option sellers or overall market makers going and having to neutralize the risk of those expiring in the money by buying shares or taking other bullish bets. There's also some increased open interest at the strike price of $6, which will prove to be another potential pressure point that you can look forward to this week. But what's interesting is this concentration of open interest at the $7.50 and $8 strike prices. You see a bit of a drop off of open interest after the $6 strike price, but then it picks up huge when you get into $7.50 and $8. Probability of this expiring in the money is less than 18% as of right now, yet you're getting more and more concentrated at these levels. If you do get a moonshot to these prices, all of these contracts are going to have to be hedged and probably will be hedged in a panic by mid to late next week. So the way that I look at it is that the main pressure point this week is likely still around $5 to $6 a share. If it simply holds that into the end of the week, you should see new breakout attempts easily. But in a situation where you get another momentum rally via either FOMO or breakout euphoria or some other catalyst that I didn't see coming, and somehow that gives you a moonshot breakout past $6 or even up to $7.50 or $8, all of a sudden you have a lot of accelerating pressure that could build onto that momentum because market makers are not factoring that in right now. Probabilities are too low. You're not going to have adequate hedging in that until you get closer to those numbers. We have 5 days and the odds are against this closing at those prices. As the days tick on, if this retains value, well, the probability increases, which means that the amount of hedging needs to increase as well. Now, keep this in mind, though. It's extremely difficult to hedge when you have a lot of the float locked up, either relent at 100% utilization, or a lot of holders that are just kind of buying, holding this and riding the wave. So far, you've been in a seller's market, not a buyer's market, which means that buyers are having a hard time finding shares, where sellers aren't having a hard time at all, because there's a huge demand for buying. When you have market makers needing to hedge more, they cause a huge influx of buy orders, which makes that situation so much more extreme. That said, you and I both know these are hype trades. These are, you play the momentum and then you get the hell out. And you and I both know that it's all fun and games to play musical chairs until the music stops. And you're left without a chair and you fall on your rear end. And unless you have a lot of padding back there, it's not going to feel too good. Okay, before we move on, I do want to tell you that I spoke with the Easter Bunny. He's a big fan of trading. I mean, he hops around a lot, so you never know what he's into. But right now, he's into trading. But he told me to remind you that our coupon code Never Give Up on ZipTrader U is expiring soon at the date in the description below. And after that, we will be raising prices. If you do join us, we'll see you 30 minutes prior to market open for the briefing tomorrow. Of course, one-time fee for lifetime access. Happy Easter. Okay, folks, so I hope you have some energy because the main topic of conversation today is the energy sector. The thesis for future momentum in this sector is based on several big themes that we are seeing right now. As of late, the conversation has shifted towards a new round of oil sanctions and efforts to reduce reliance on the Russians. And the more that kind of talk amps up, the hotter the oil disruption trade is going to be because traders are going to anticipate these countries going and having to bid up oil supplies everywhere else. If they're no longer buying oil or any sort of energy from Russia, where are they buying it from? Other sources, which means they're bidding up those prices, which are already skyrocketing. And of course, anything new that Russia does to escalate the crisis over in Ukraine, that's also going to be seen as a threat to further lock off Russia from the global energy supply. And UBS has predicted that tighter supplies will push the commodity back to $125 a barrel this summer. And I believe there's a very strong chance that you see even higher than those prices, at least temporarily, before we get to that point. No, I can't tell you what oil is going to do tomorrow or the next day. It's possible that efforts from the White House or other countries or for industry causes some short-term pullbacks. But I believe that overall, the trend of energy and oil prices is going to get worse before it gets better, which means trading opportunities. And there's a few big trading plays that you should know about heading into this week and the upcoming weeks. The hottest as of late is Indo, HUSA, and some others like IMPP and CEI. Let's talk about a couple here. We'll start with Indo. Now, Indo popped up huge, something like 65% the last trading day, and I'm not saying it's a good buy right now because it really depends on the scale of when energy disruption fear gets factored into the price. And that's based on a lot of different catalysts that are difficult to predict. But I want to pick your brain about the setup because the overall trend is very, very interesting. You open up the chart, yes, the run towards the end of last week was substantial, but based on where the energy trade goes, you could certainly see a lot of bigger retracement in a faster time horizon than we saw the first time. If you followed us the last couple of months, back on February 24th, we started briefing on Indo again as an energy play, along with our shorting of the NASDAQ and other trades that were in favor as Russia had invaded. It was trading somewhere around $13 a share, and it ran up to just under $87 before energy took a breather and escalation fears calmed down. So anyways, if you're looking at this specific play, what are the odds that we retrace? Well, the angle for Indo is really two things. One is it's proven history as a spec hype play that runs up multiples of what oil runs up. Two, its recent announcement that they started drilling the first of 2 back-to-back production oil wells, which if successful, they say will bring in 100 barrels of oil per day over the first year of production. You also have 18 other new production wells in that same block expected by the end of 2024, which means rolling catalysts for boosting production. Three, the other thing to keep in mind is their production costs only $24.51 per barrel of oil as of the latest report. And remember, when oil prices go up, that doesn't mean that the cost to drill that oil goes up, although it may. But for the most part, it just means that the global supply is having a hard time meeting demand. So the more that prices go up relative to your cost, the more potential profit you have. Considering Indo isn't based in Russia, it will be one of the players that benefits from the global benchmark prices. And of course, the higher that oil prices go, the more margin for profit they have. So if we get another breakout in oil this week, which I would argue is a high likelihood, I would expect Indo to see more trading opportunities on momentum. Don't be surprised to see a big cool off towards the beginning of the week though, as we did just have this massive increase. Another spec oil trade to be aware of is HUSA, and perhaps I even like this one more. This one's based in Houston, Texas, and has a market cap of only $48 million. HUSA cares Charlotte. Well, Misa cares. HUSA is intriguing for a few different reasons. It's tied to both natural gas and crude oil prices, both of which are likely to skyrocket during several periods before the summer. It's also based in the US, which is a big plus. Capital tends to flock more to trusted markets. The only issue that comes with that is that their production costs are a little higher than Indo's, sitting at $33.67. So anyways, folks, I highly recommend looking for momentum trading opportunities this week on stocks like your Indo, your HUSA, your CEI, and your IMPP with the unfortunate ticker name. There are some others that I didn't touch on, but these are the ones that I'm the most familiar with. Anyways, folks, that caps off today's video. If you have any questions, feel free to reach out to us below or join us on ZipTrader Circle. If you'd like to lock in our lifetime access for the discounted price right now, make sure to use coupon code NEVERGIVEUP before checkout on ZipTrader U. If you're looking for a powerful trading app to step up your trading game to the next level, I'll put a link to Moomoo down below, and they are offering up to 6 free stocks when you both sign up and deposit with our link below. Have a good one, folks, and I'll see you in the next video.